Okay, so we are in Module 2 of our Management 215, and this corresponds actually to Chapter 2 in the textbook, Warren's Survey of Accounting. Okay, and I want to first sort of take a moment and pause here on the title slide from the PowerPoint, and the title of the chapter is Cash Basis. So one of the things you need to realize is that, in the most simplistic world, right, a business runs in cash. The kid who, helps us with our gardening, he comes over, he works for an hour, we Venmo him $10. That's the end of that. And so in his financial records, he just would write down, Tammy paid me $10. But what if we didn't pay him till the end of the week, right? He'd have to keep track of how much I owed him. And when you have an accounting system that isn't just cash, but where the accountants and the business people need to keep track of things that are not going on in cash right at the moment, then that becomes a whole different system, which we will look at in Chapter 3, right? So in Chapter 2, we're just going to have the most simple accounting system possible, a cash accounting system. We're going to talk through where the financial statements come from, basically. So what we're going to do in this chapter is basically we're going to just talk about a financial accounting system in general, and then we are going to do what's called transaction analysis. And that's really going to be the basis for all of the quantitative homework, all right? Transaction tracking. And then we're going to create financial statements based on the transactions that we have recorded properly. So that's what we're doing in this chapter. So one of the things about financial accounting and the accounting system is that it's very, very rules oriented. There is a rule for how to treat every transaction, right? The rules are called Generally Accepted Accounting Principles, or GAAP. They are continually being revised and updated based on changes in the way that we do business. Transaction, just to be clear about what a transaction is an economic event that affects financial statements, right? So a transaction would be, for instance, buying a truck, making a sale, taking on a loan, issuing stock and getting cash from your stockholders. These are all transactions, and there are generally accepted accounting principles that tell you how you need to record them. So the accounting equation is the basis for how we have to record transactions. We have to record all transactions in such a way that the accounting equation always holds. That means that every transaction that we record has to be recorded such that the assets always equal your liabilities and equity. And what this turns out to be is every transaction has to be recorded in at least 2 places, such that your assets are always equal to your liabilities and equity. That's called double entry bookkeeping. You may have heard that phrase before. Okay? So this is sort of the framework that we use to both record transactions and generate financial statements out of them. Okay? So what happens is, if you look over here, right, a transaction occurs and it is recorded in such a way that the assets always equal the liabilities plus the equity. And then those accounts and the account balances flow directly into the balance sheet. They also flow, once you've recorded all your transactions and this whole upper piece is done, right? All these events also flow into the statement of cash flows and into your income statement. Okay, so this is sort of the framework that we're going to use for all of this transaction analysis that we are about to undertake. Now, there are a few what they're calling controls that tell you, that indicate that you might have done it right. And in my world, right, I do this all in Excel, right? So, and I'll show you how. But so I set up these checks in my spreadsheet to make sure that the accounting equation balances. So I create a balance check to make sure that my assets are equal to my liabilities and equity. I set up the spreadsheet such that the ending cash on the statement of cash flows must equal the cash on the balance sheet. That's sort of how you build the financial statement. And that the net income has to flow through from the income statement into the net effects of revenues and expenses on the retained earnings, which is included in your statement of changes in stockholders' equity. Now, all that was very abstract. I know, I just kind of took you through some very basic slides and twirled my mouse pointer around a little bit. All right, this is the sort of the overview background of what we're going to do, but it's not going to make any kind of sense until we actually start doing it. Okay, so let's get to it.